Hello, and today we're talking about bull put spreads. These are sometimes called short put spreads, put credit spreads, or selling a put spread. This strategy is really good because it uses your capital efficiently. You can define your max loss on a short position, and it also allows smaller accounts to play on higher price equities that they would otherwise not be able to make a trade on. So the setup of this trade is pretty simple. It consists of two put contracts. You sell a put option, and then you buy another put option contract at a lower strike at the same expiration. And why you do this is because if the price goes against you and goes down to zero, whatever, your max loss is defined because you have that contract that you bought that recovered up that difference. Like if you're assigned on your short contract, you would exercise your long contract to buy the shares at that price or to force someone to sell you those shares at that price. So your max loss on this trade is the difference between your strike prices times 100 minus the premium you receive. And the max profit of this trade is the premium that you receive. Now I'm going to go to a website, optionsprofitcalculator.com. This website is great for learning how all these different strategies with contracts work. And in this example, we're going to go to the put spread. And I'm just going to choose a stock. We'll do SoFi. I know that's been popular recently. You choose whatever stocks that you're bullish on when you're doing this. This is not a recommendation for SoFi. This is just an example. So if you hit get price, it'll show you the price here. Then we're going to the short option. Click select. I'm going to do July 2nd because that's next week. And I'm going to sell the 1850, saying I think SoFi is going to be above 1850 at the end of next week. The next step is I'm going to go and click select option, and for the buy one, I'm going to move down $1 in strike price, so 1750. And I'm going to go ahead and choose the 1750. So the difference between these is $1, which means my max loss is $100 on this trade. But what ends up happening is I'm selling this guy for 96 cents, and I'm buying this one for 45 for a net credit. So my max loss is actually the $100 minus that 51. I'm going to go ahead and click calculate here. I actually want to get this to go a little lower so you can see the P&L a little better. And it gives you a nice little graph showing you what the spread would be worth as time goes on, depending on the price of the stock. So up here, you can see my entry cost for this is $51 of a net credit. So I got paid $51 to put on this trade. My max loss is that I lose that credit and $49. So this is a nice little way that you can double your money if you're feeling this aggressive. You can turn the $49 into 51. So that's pretty cool, actually. This website also gives you a probability of profit. I'm not sure how much I'd trust that. What I would do is I would go into Thinkorswim or whatever program that you're using for your charting and check the probability of profit there. Make sure like everything works out in your favor there. But a 1-to-1 payout for a 64% chance, that's better than going to the casino and betting on black. So as we look at this, we can see on expiration, even if it's under 1850, which is our short put, we still have room that we make a profit. That's because we receive such a large credit to enter this spread. And then if it goes below 1750, our max loss is reached, and that's $49. Because after that, we'd be exercising our 1750 contract to make up the difference of the losses. Another neat thing about this website is at the bottom here. If you don't like using a table, you can go to a graph. And I think this is the one I want to do. And again, you can see what their spread would be worth, depending on what day it is, if you're looking at the different lines here. So this dark one here is the date of expiration. So depending on where the price is on the stock, it'll show you where you're at max profit, which is above the 1850, or max loss is 1750. Now, if I'm doing this sort of trade, and I would say this is very aggressive because this was at the money, I might put in a automatic profit taker to take it at 50% profit. So just something to think about if you're going to be using this strategy is you might want to put in a profit taker to take it in the event that you're not at the computer when it goes on profit. Now, this strategy is also good because it lets a smaller account play on higher price options. So I'm going to say let's do one on Apple real quick. Apple's trading at 133. That's pretty expensive for my blood. So come over here and let's say I'm gonna get more conservative and I'll sell the 130 put contract for 34 cents. But I don't have $13,000 in my account to play on this stock. That's fine because we're doing a spread. So we did 130. Let's go down to 129. And so what you can see is I'm being paid $10 to put on this trade, and the max loss is going to be $90 because it's this strike difference, $1 times 100 minus the premium that you're receiving. If we go down here, that's what we can see is max loss is 90 at expiration. So this is still a 10% return on your money in a week because you're using these spreads. Now, some of you be saying, why am I buying this long put here? That's just to define your max loss. Like, yes, you're giving back some premium, but you're defining your max loss. So instead of potentially losing $13,000 if Apple went to zero, your max loss is $90 on this trade. So that's why you give a little bit back to put on this trade. And here's the P&L graph. I like looking at the table, so let's switch that back. You can see there's your P&L. Once you get past your long strike, your max loss is defined as the $90. So it's important to get like some good credit. I think one of the recommendations is that your net credit should be 30% of the width of the trade, and I guess that helps for like probability of winning your trade. This guide shows an 82% chance of getting that 10% return in a week. That's pretty cool. If we go back to the contracts here, a quick way to see how much you're going to get is to look at the price between the two contracts that you're looking at, and that's going to be your credit that you receive. So $1.20 minus 80 or minus 79 is 41 cents. So if I was to do the 133 to 132, my max loss would be about $60 on this trade. And you can do that math quickly looking at the options chain, especially on stocks where you have $1 strikes. Another thing you can do is you can put on multiple contracts to get a larger amount. So if I had $1,000, I could put on 10 of these contracts. Or another option I might have is maybe I'll do the 130, and since I have $1,000 to put on this trade, maybe I just make the spread larger. So 130, I'll be selling the 120 then, and calculate. And then here you can see my max loss is 972, and I get a bigger credit. But by using a larger spread, I have more options to manage the trade if it goes wrong. And I think that pretty much covers this up. Like, use this website. It's great for figuring out how all these option strategies work. You could play around with putting in different strikes, different length of contracts, and you can see how those work. This is a great strategy. I do it from time to time. I mostly prefer naked puts because I know how to manage those really well. Whereas on put spreads, the point of doing the buying that protection or making it a spread is that your max loss is defined and you're willing to take that. So that's the way I view these put spreads. But if you're a gambler, you can double your money in a week using this strategy, which is actually pretty cool. That's available to you. If you like this, like, subscribe, share, and at least let me know your thoughts in the comments below. I'd love to read that and respond. I am not a financial advisor. Any information included in this video is for informational and entertainment purposes only. It is not intended to be investment advice. Please seek a licensed professional for investment, tax, or legal advice.